Does it work? Yeah. Cool, perfect. Yeah, welcome everyone. Maybe we start with a quick introduction round. Maybe one of you can just quickly introduce themselves and the project they're working with. Maybe just focus on specifically sort of the problem in DeFi you guys are addressing and how you came to tackle that issue specifically.
Yeah, sure. I'll start. So glad to be here. My name's Sid. I'm the CEO and co-founder of Maple Finance. For those who don't know us, we bill ourselves as an on-chain asset manager. Really, the focus is lending. So we do over-collateralized loans to institutions. And on the other side of that is, of course, a yield product. So it's a way to earn yield. We run around 4 billion AUM today, but I'd say that the problem that we stepped in to fill was really that there was a massive undersupply of loans or the ability to borrow. Certainly after FTX at the end of 2022, so we stepped in. We've been doing that since, and institutions will generally borrow for trading, investment, deal flow, any number of things.
Hey guys, my name is Benjamin. I'm the founder of CAP. We're also a stablecoin protocol for yield. The two problems we're trying to solve is one, safety. So a lot of teams, a lot of products for yield require you to trust teams, require you to trust executions, and so we don't do that. We rely only on on-chain logic. And the other part is source of yield. So most of the yield in crypto is either from crypto leverage or from T-bills. And so I think if we want to grow yield for stablecoins, we have to get out of that dynamic of just having two yield sources.
Hey guys, Wilbert from Pendle. I'm part of the ecosystem team. So what Pendle is, and we're a yield tokenization protocol as well as the largest fixed rates market in DeFi. The problem we're trying to solve is, with DeFi yields, there's a lot of variability with DeFi yields. It's very recursive in nature. A lot of yields are dependent on project token incentives. Pendle is trying to bring about fixed rates to the whole DeFi ecosystem. So anything that has variable yields can be brought to Pendle, and there's a way to earn fixed rates with that with Pendle principal tokens.
I'm Raphael, working for Arrakis, not Arrakis. But we help projects to improve their DEX liquidity, sort of like help them to generate sustainable and deep liquidity on AUM markets. Maybe that's also a topic to start. Like when I came into crypto, everyone was talking about liquidity and sort of like LP incentives. Nowadays, everyone's talking about yield. Like you just mentioned, everyone just dropped the term yield. Where do you see sort of the market shifting, and what do you think is the reason for this shift?
I think LP incentives still play a big role. If you look at any new token or protocol launching, generally they'll have some kind of incentivization component. But I think that the amount it's done now versus in 2022 is far less. I think now there's much more of an emphasis on how you generate sustainable yield, whether it's from lending, staking, basis, trading, and there's more of an emphasis or scrutiny of how sustainable that yield is, and I guess the quality of the yield. Whereas before, I think it was much more on how many tokens are going to be provided as incentives, and we've seen the space go through token incentives to points. And I think now as we've got more institutional capital in and larger investors in there, this is more focused on longevity there.
Yeah, I can speak for yield-bearing stablecoins, and in the past, the reason we had a lot of DEX incentives was that most major stablecoins were synthetic, and particularly CDPs. So Arrakis, MakerDAO, even Frax, they weren't a CDP, but they were synthetic, right? So they weren't fully backed. And so all these projects, they needed to manage secondary liquidity in order to keep their pegs. Today, that's not the case. Right now, CDPs are, I don't want to say dead, but nobody really uses them too much. The new way has been reserve-backed stablecoins, or strategy-backed reserve assets. So you look at Athena, that's a reserve-backed stablecoin. Even Reserve USDC could be looked at as a reserve stablecoin, and CAP as well. And we don't really have to worry too much about PEG, because in both of our projects, for example, you can just redeem right? And that primary liquidity serves as the DEX liquidity. Maybe permission minting like Ethena, they have to worry a little bit about about maintaining peg, but because there is a redemption module, it's not as profound. And that's really why we haven't seen a lot of DEX kind of incentives.
Yeah, I think I'd like to share some perspective on Pendle's side of things because we're so intertwined with the whole token incentive model. A lot of these protocols that we work with Maple, work with Cap. I think I agree with what Seed said. I think that the focus has shifted a lot to sustainable yield source as well as sustainable incentive programs. Points and incentives are still relevant, but they're not the focus today. I think the focus has shifted more towards how do we generate sustainable yields that are attractive for users. I think points and incentives are only probably a way to buy time for distribution to happen within DeFi, and that's something that a lot of protocols realize that DeFi capital and liquidity isn't cheap. If you look at supply rates on Aave, it's like 7% for stablecoins. And you've got to compete with that if you want to attract capital to your product, right? So it has to be above the DeFi risk-free rate or above T-bill rates for that matter. So I think a lot of protocols are starting to think of ways to make the yield source sustainable, as well as find interesting ways to attract users to use their products.
Just heard the word sustainable a lot. Like when I think back towards the meltdown with Luna and everything, leverage was a big game, and leverage something I see in the system today a lot. Like almost every customer who comes to us about deep liquidity actually wants deep liquidity because of the looping and the unwinding of looping, and now all the yield-bearing assets you guys provide, they get leveraged a lot. Like, how do you see risk management these days? Especially like considering potential risks of like another collapse of the entire system due to this over leverage game.
We have the product CERT USDC and CERT USDT, which are used as collateral, so they are looped, and so that requires us to then think about how do we protect risk on the downside so that people aren't getting liquidated and creating cascade. But I think to what Benjamin was saying earlier, if you have the ability to redeem your assets, and if you have very sort of solid yield generating mechanism underneath, like in our case, it's I would say on the lower risk side, it's what we're collateralized lending, then really the type of risk you're looking to prevent from occurring is more liquidity in nature. So it's how do I allow people who are doing the loop enough liquidity to get out so they don't get stuck in the trade. And so we've had to focus on secondary market depth, ensuring that we have a lot of enough of a liquidity buffer underpinning the asset. So let's say 10%, so that people can do redemptions or they can hit the secondary market if they need to get out. But I would say it's more liquidity rather than asset quality. It's kind of an issue that you need to protect against.
I agree with what said. For us, we maintain a buffer of 10%, and that's enough to service any immediate liquidity needs. More broadly, it's not Terra anymore, right? Like Terra, you were looping nothing, and so if you try to liquidate nothing, you're going to get nothing. Whereas with us, you can liquidate all of the market capital stablecoin today for USDC and no slippage, and so there's no scenario in which you would have a problem with liquidations. I do think that there is a problem with some of the lending market practices that we've seen. There are some cases of very large looping positions in crypto, this is not naming names, but where there are hard coding collaterals. And if we learn anything from previous experiences, is that hard coding collaterals is the first way for a lending market to have bad debt. And we have seen that a lot in this space today, and I hope that changes.
Yeah, I think it depends on the underlying assets as well. If it's over-collateralized stablecoins like CERT USDC, it's not too much of a concern. It's just a matter of time before you have the liquidity buffer to redeem your users. But I think certain assets that you're clearing at, stablecoins that we've seen in this space that are higher up on the risk curve, they're trying to back their stablecoins by longer-term private credit assets. I think some of those protocols do deserve to be scrutinized a little bit more. But I think with most strategies, for example, most of these are very liquid strategies that they could easily unwind in a couple of days, and meet those redemption needs that they have. But I think for certain assets where they're backed by perhaps private credit or real estate where it's not as liquid, they need to be very concerned about the secondary market liquidity that they have available, as well as the primary liquidity buffers that they have available.
You just mentioned real estate and other sort of like traditional financial assets. I think that's something we can definitely see this year, sort of like traditional institutions coming on chain, getting more interested, bankers getting more interested. For all of those entities, risk management and regulation is extremely important, but especially sort of like things like hedging and unwinding positions, but also in general the risk management framework. How would you describe sort of that your entities are gearing up for this and becoming interesting and attractive for these traditional financial players to invest in?
Sure, I can go first. So I think one of the things that's got them interested is where can they find things that they can't get in traditional finance? And so, lending against Bitcoin has been a sector that we've been pitching, and I think we've started to see some traction on that front, right? Cantor Fitzgerald has started doing Bitcoin-backed lending since the start of the year. JP Morgan signaled some interest in looking at this. But I would say part of the issue has been, that things like Bitcoin-backed lending kind of sit in this awkward in-between stage. It's not as lower rating, it's not as lower yield as what you get for rated investment-grade stuff. But then at the other end of the spectrum, you have private credit on 3 to 5 year horizons, which yields 12 to 13%. But it's not at the yields on Bitcoin-backed lending aren't at those kind of eye-watering levels. Nonetheless, I'd say what has got them interested is that they see that the sector is kind of mature now. Bitcoin has a $2 trillion plus market cap, so I think they can definitely see that there is size now that can accommodate institutional allocators. And I think more than anything, they're looking at the possibility of getting a rating on this type of stuff. So rating on crypto yield products or crypto fixed income products. And so since that they can see that could happen, that means they're now more confident they would be able to sell this to their LPs. And that was really the big issue on the buy side, was they didn't see as much demand from LPs for this type of stuff. We've seen a lot of demand for crypto venture, for crypto trading, but not for like investment grade products. So I think that's the thing that started to thaw this year and why I can see it happening in the next 12 months.
I completely agree with that first sentence. You said you have to do something that you can't get outside of crypto. And I think a big issue that we have today is that even though we have a lot of stablecoins, most of them are just T-bill stablecoins. And I think this is a very bad focus for our industry, because any number of financial institutions or even Web2 platforms or normal retailers can make T-bill stablecoins and they will instantly be better than what we're making as startups. I think our job is to innovate and kind of somehow improve the financial system. And for us, we get a lot of interest from institutions because the folks generating the yield for CUSD, which is our stable dollar, are not just crypto traders or entities like that. They're large institutions like Susquehanna, IMC Trading, Franklin Templeton, and so we do see a lot of willingness for them to participate in these sort of programs because they see how that it can improve the markets that they're already participating in outside of crypto.
Yeah, I think on our side we're seeing a lot of interest from institutions to access DeFi yields. And one of the ways that we're thinking about approaching it is potentially exploring a permission instance of Pendle. And that will be something that we're exploring towards the end of this year. So the idea is that you've got a bunch of these institutions like Apollo and Securitize, BlackRock. These guys have permission assets like Pendle and Apollo as a cred. So a lot of these assets can be put on chain, but previously, again, like I think what Sid was saying earlier, there was no demand from institutions. But now they see the benefits of having these assets on chain, whether it's for settlement purposes or for rehypothecation or to earn higher yields. And that's something that require users to be KYC, they require the whole ecosystem environment to be KYC. So it's something that we're building out towards the end of this year. And we'll be probably piloting with a certain number of protocols like Apollo and Centrifuge and Securitize. So that's something that I think we're exploring The other thing we're thinking about when it comes to institutions is that there's also this learning curve where they're still trying to understand like what are the benefits of DeFi, what are the risks associated with smart contracts. That is something that they're still not able to quantify, and it's not something that they could hedge when it comes to smart contract risk. So that's probably a problem that needs to be solved in the coming years or coming months.
You guys, Ben and Will, you just touched upon sort of, like how to bring yield to institutions, and that you need to offer something that they can't find elsewhere. When I think back at my days in banks, where I've been many years, like already explaining them the simple sort of value proposition from crypto was very tough. Like what do you think we need to sort of communicate to them, and like how do we need to prepare DeFi protocols to actually be attractive? And you touched up on KYC. I think that's definitely one point. But what are other elements we need to introduce to be ready for the global adoption of institutions?
Maybe I'll break up the order, keep it interesting. Traffic people are not dumb, right? Like they understand this better than most crypto entities. And this is because there's way more competition for the same rules in TradFi that we're getting crypto. So what we found when we're interacting with asset managers like Fidelity or Franklin Templeton, etc., is that it takes them very little time to understand what we're building. What does take them a while is getting comfortable with the compliance side. And you touched on it a little bit, and the permission aspect is something that interests them a lot. Privacy is something else that we've heard from them. But in general, those have not been impediments for them to participate, because at least at CAP, they're already participating in the system. I think the broader regulatory environment has done more than we need to do, right? We don't need to change a lot of our products. We just need to hope that regulations keep going the way they're going.
I think you kind of have to go back to self-interest and the profit motive. So most of these firms are actually only interested if you can generate them a higher return than what they can get doing other stuff. That's what has got most of them interested in lending, providing loans or funding against Bitcoins that they think they're going to get better pricing than what regular high yield does. So I think that's actually been the most potent selling point, has been that they can get a higher return doing these types of projects. And that helps overcome the aversion to the risk and on the compliance side of things. And the other thing they have to see is that it can scale, and that they can do hundreds of millions or billions of dollars, because a lot of these firms looking at it have very large balance sheets, so they can't really take a flyer on something that's too nascent or is not going to properly scale.
I think on that note, talking about higher yields, probably pretty apt to talk about Pendle looping, PTs. I think that's a lot of the TVL growth that we've seen this year is no secret. It's coming from Athena and Pendle, and Aave accepting Pendle's principal tokens as a source of collateral. I think right now Pendle's PT on Athena's stablecoins are going at like 10%, and that's a huge amount of liquidity in there. I think over 7 or 8 billion just sitting in PTs. It's about 6 billion on Aave right now in fixed rate Pendle PT positions that users are actively borrowing against. The collateral, the PTs are earning maybe 9-10%, and you could borrow for 6-7% if you were to do that multiple times and loop up, and that you could get something like 30% on stablecoins with a relatively risk-adjusted managed portfolio. So I think it's something that a lot of institutions are looking into. Those are sources of yield that they would otherwise not be able to get outside of crypto. Our thesis also is that funding rate is one of the largest sources of yields in crypto. If you look at perps, like a lot of these funding rates have been pretty crazy. We actually just built a new product under Pendle's brand. It's a perp DEX for trading funding rates. I'm not sure if you've heard of it. It's called Boros, but I think it's worth looking into. But the idea is that it will be a perp DEX that allows you to trade or go long short on funding rates of different assets like BTC and ETH. And the main use case is actually, for guys like Athena or anyone that's doing basis strategies, if you're running a fund, if you're trying to hedge funding rates today, you're not able to do so. When the funding rates are in a better market, it could be like 20-30% on BTC, but there's no way to really hedge that. So on Boros right now, you could go short. It's almost like an interest rate swaps protocol, so you end up receiving the fixed rate, and then you're just participating underlying. So even if the market was to go into a bear market, you would still be able to receive double-digit, funding rate yields. So that's something that we are trying to solve at Pendle, consistently trying to bring about more sustainable fixed rates, fixed sources of yields to DeFi.
I think we've spoken a lot about yield, and there are all these forms and types of yield. Like, one principle of finance is like there's no yield without sort of a risk associated. How do you judge the current risks in DeFi, and what do you think is sort of like the biggest risk we see in the current evolving of the DeFi ecosystem?
I can go again. I think probably a lot of users look at Athena as like probably one of the stablecoins with the largest TVL right now, and they're like, what's the risk behind that, right? But I think going back to my earlier point about how Athena strategies are pretty simple to unwind if they had to, it would cause some movement in the markets, but I think given that they're pretty hedged, it would not be like a huge thing. And also with Athena, I think a lot of the yields are coming from basis strategies, right? So they have a spot position, they're long run, and they're short curves. So that's something that I think a lot of users were also questioning, like what happens if funding rates were to go into a negative rate environment. I think something that Athena has done pretty well is to diversify their portfolio strategies and underlying yield strategies into things like T-bills, Pendle, right? That's a way to hedge rates in case the funding rates were to drop below the risk-free rate, and they would simply pivot into more of a defensive portfolio by holding more T-bills from a securitized or Pendle.
I'm from a different school of thought. From where I come from, I think you should minimize the risk as much as possible and minimize your trust for third parties. If you're going to trust somebody, better to trust somebody that's regulated, right? When you're putting funds into a protocol, you're either trusting the team, you're trusting smart contracts, or now with Franklin and BlackRock coming in, you're trusting regulated entities. I think it's fine to trust the regulated entities because there's recourse. If they do something bad, you can sue them. You can trust smart contracts because if you can get around analyzing how they work, you know the downside. Teams, I'm not too sure because last cycle we saw a lot of people lose a lot of money because they trusted teams. And these are protocols that are headquartered in the Caymans or BVI, have fun suing them, right? If you lose your money, for example, what happened with multi-chain, they got hacked for $100 and something million. To this day, people don't have their money back, and it's all because we trusted centralized systems where the teams had a lot of admin control of user funds. And what I wish for our industry is to improve user safety. And so, anyways, I actually think that we're slowly going back into this idea of trusting teams, which is something that we should have learned last cycle. And I hope we don't continue going in that direction and we fix it and we go back to this idea of trustless finance.
I'll disagree on the regulated bit. I mean, Lehman Brothers was regulated, right? Like all of the 2008.
Banks that went down versus DeFi protocols.
Only because they got a taxpayer bailout. So I think sort of things I see managed much better from a risk perspective nowadays than 2022 is probably counterparty risk. I think in the lending space nowadays you see a lot more tri-party accounts used at custodians. There's very little uncollateralized lending that I kind of see happening in the market. And but to your point earlier, Raphael, you of course are getting paid for something. And so I think you've got to have an understanding of the yield I'm getting paid. Effectively, what am I getting paid for? And I think in the over-collateralized lending space or lending against Bitcoin and other large caps, you're still getting paid quite a lot of what I would call new technology premium. So a lot of traditional finance players view this as too risky. They don't like stablecoins. They're unsure that Bitcoin is a viable collateral. And I think you're still getting paid a decent premium for that. I think over time, over the next few years, you're going to see that drop. Like the amount of yield you get paid just for lending against Bitcoin, which trades, $50, $60 billion a day, even on Sundays. You're not going to get paid as much as you currently do today for lending against that because people will come to realize it's actually a relatively safe proposition. But the other thing, of course, you can be getting paid for is liquidity. So I think what we saw recently with Kiln withdrawing from the ETH staking queue is that the amount of time it takes to get out of that, has spiked significantly, and a lot of people are kind of underpricing effectively how much they're getting paid as a kind of liquidity risk compensation. So I'd say the two things you get paid for these days are really liquidity and counterparty credits.
Maybe to reiterate on the liquidity point, I think you said it once in a podcast that sort of the liquidity has been one of the drivers for Syrup USDC and why Syrup has been so successful on the yield-bearing asset side. Could you maybe elaborate on this, like why your team backed initially? I think in the early days of Syrup USDC, we at Arrakis have been sitting together with your team discussing the liquidity topic and went straight ahead and really built on very deep liquidity, especially DEX liquidity at the beginning. Maybe reiterate on this and like why you think that was a driver for the success of the asset.
Sure, it's a good question. So the type of lending we do under the hood is, we write loans to institutions, and that means they might take some time to pay it back. So, I might give a loan to an exchange, and we have the ability to recall it back in 30 days. Now, what this meant is it would take you as a depositor 30 days to get your money back. This was off-putting for a number of folks who wanted the ability to get it back instantly. So what we worked on with Arrakis and what we've built out was secondary markets. So you could put your money in, and then there's a secondary market so you could get back to USDC within a day if you wanted to. That then opened up the ability for more protocols to partner with us and for lending markets like Morpho to accept us as collateral, because suddenly they would have the ability to liquidate the collateral if they needed. So I think in that sense, it really was liquidity that kind of opened up the growth of this product. And nowadays we have, it's more than $1 billion of Syrup USDC minted. The overall AUM of the product is now, $3 billion. It's 3/4 of our overall AUM altogether. So a lot of that traces back to liquidity.
Yeah, and you touched upon regulation before and like how it becomes more and more important, especially when targeting TradFi. How do you think like recent developments this year with like the Genius Act and others will really shape the way forward, and will shape the way forward also for your protocol building stable coins and yield-bearing assets?
For starters, no one's saying stablecoins anymore. Now we're all calling ourselves digital dollars. And I think you've seen that across the DeFi space. People are trying to, at least in nomenclature, be compliant. From our point of view, it hasn't really affected our product too much because we're more of a lending market like Maple is. And we never claim to have a peg. And so we're not really covered by the Genius Act. I hope that there are regulations for DeFi though, because that would allow us to have more exposure to American institutions. But yeah, even now, even though a lot of DeFi is not covered by regulations like the Genius Act, you still see all the large asset managers pretty involved within DeFi.
You just said you're wishing for regulation in DeFi. How do you think that evolving if DeFi is evolving so quickly? I can barely catch up with all the new innovations and things happening.
Well, that's what happens with any industry, right? There's a lot of innovation. The government doesn't know what to do. The people lose money or they die. Bad things happen, right? And then the government comes in and regulates it. It's kind of like the cycle of any industry.
Cool. Maybe to close off, I'd like to hear from all you guys. How do you think 5 years forward? How's DeFi gonna look like? What are going to be the topics? We're going to talk about today. We talked a lot about yield. What are we going to talk about in 5 years?
I think from my perspective, DeFi as we know it wouldn't even be called DeFi in 5 years' time. Probably be abstracted and just be part of finance, with just different sources of yield, different protocol mechanisms built on the blockchain. But a lot of that complexity will be abstracted away for the average user. And I think that's essential in order for mass adoption to happen. Right? We keep talking about mass adoption, but really this liquidity that we're playing with is just sitting in this small DeFi bubble, crypto bubble that we know it. When if you look at TradFi derivatives market, they're a $500 trillion market, so I think the potential is there. And in order for DeFi to be mainstream, it wouldn't even be called DeFi 5 years from now. We're seeing a trend, obviously a movement towards more yield-bearing stablecoins or digital dollars. Today, we probably have more different yield-bearing stablecoins than protocols available. everyone's trying to come up with their own version of yield-bearing stablecoins or digital dollars, and I think that will continue to be the trend moving forward. So I think it's important for UI and tools like wallet abstraction apps and chain abstraction tools and infra to be around in order for users to not have to be caught up in the more complexity and just be able to reap the benefits of DeFi without all that complexity and yeah.
I agree with you as well. I think it's something called finance, right? Not so much DeFi, but also liquidity, right? As people become more comfortable, as regulations come on board, we will no longer just depend on the market cap of using TUSDC, right? To grow yield products, we will be able to get sources of yield, sources of liquidity outside of that, and then that will bring down premiums because it's insane that right now you have to pay anywhere from even 8-9% Morpho to borrow against over-collateralized loan. In my opinion, an over-collateralized loan, a Morpho navigate is just as safe as most products outside of the blockchain. So surely those yields will start to go down as well.
I think you'll continue to see growth of stablecoins into the trillions of dollars. I think over the next 3 years. And the other thing I am kind of keeping an eye out for is I think today over-collateralized lending kind of sits around 20 to 25 billion. So it's still lower than it was during 2022. But I think over the next 5 years, you'll see that balloon to, my guess is maybe like 200 billion over the next sort of 3 years. And I think the catalysts for that are going to be more stablecoin adoption, continued growth. I think everyone in this room probably believes Bitcoin, it's not unrealistic for it to double over the next few years. And then the continued penetration of more institutions coming in. So I think overall you're going to see DeFi massively expand as a sector. I think that is going to be the biggest beneficiary of regulation, as Ben was saying before. But yeah, that's my prediction for the next 3 years is, you'll see hundreds of billions of Bitcoin-backed lending. Particularly, I would say, if you look at the generational differences are, for boomers, most of their wealth was accumulated through real estate, and I think a lot of our generation, so millennials and Gen Z, we don't have that. Like real estate can't, go off the same number of multiples it has in the past, but Bitcoin is going to make its way into everyone's portfolio. And I think Bitcoin and digital assets is going to be the kind of the vehicle for wealth creation. So you'll see a lot more products built around.
Cool, I can only second that. Thanks a lot for sharing your opinions today, and looking forward to seeing DeFi evolve in the next years.
Thanks for having us.
Thank you.